Tesla just dropped its second quarter 2025 earnings report, and Elon Musk and his team had a lot to say. We've got robotaxis now officially on the streets, huge updates on the Optimus humanoid robot, but also some serious financial headwinds that are causing a bit of a concern. Is the AI future bright enough to overlook the short-term pain? Well, let's break it down. So, how did Tesla stack up against Wall Street expectations? Well, it's not quite what investors were hoping for. In terms of revenue, Tesla delivered $22.5 billion, which missed analyst estimates of $22.64 billion, and was a 12% year-over-year decline. Now into earnings per share, this was also a miss. Tesla posted an EPS of around 40 cents a share, falling short of the 42 cents many analysts were expecting. The company pointed to rising tariff costs and heavy R&D spending as the main culprits. Now, one bright spot was Tesla's gross margins, which came in at around 17.2% versus an expected 16.5%. Now, with that said, it was still a decrease from last year. Along with that, revenue from supercharging and vehicle services rose to around $2.9 billion, a nearly 18% increase from last year. Now, let's look at free cash flow. This was the biggest shock of the report. Tesla generated around $146 million in free cash flow, an 89% year-over-year decline, and a massive miss compared to the nearly $760 million Wall Street had expected. A huge reason for this drop is a massive increase in spending. Capital expenditures are now expected to exceed $9 billion for 2025. Now, along with the somewhat disappointing earnings, Tesla also faces some continued headwinds moving forward. One of the big ones is the repeal of the $7,500 EV tax credit in the US at the end of this quarter. The company is warning that this could seriously impact demand. If you're in the US and want a Tesla, their message was clear. Let's roll now. Then there are the tariffs. These add an extra $300 million in cost this quarter alone, and Tesla expects that number to grow. Now, looking past the headwinds, the sci-fi future looks bright. The big story of the quarter, and maybe this year, is autonomy. Elon Musk kicked off the call announcing that the robotaxi service is officially live in Austin, Texas. Elon's goal is to get the regulatory approval to expand the service to cover half of the US population by the end of 2025, which is quite an ambitious timeline. Now, the star of the show, well, that was Optimus. Elon Musk sounded incredibly confident, predicting that the prototype of the exquisite Optimus 3 design will be ready in about 3 months, with production starting early next year. His reasonable aspiration is to be producing 100,000 humanoid robots per month within 5 years. He repeated his belief that Optimus will eventually be Tesla's biggest product. Now, on the AI front, Musk said that the Dojo 2 supercomputer and a new AI factory are both targeted to be in production by the end of next year, further cementing their lead in what he calls real-world AI. And what about that cheaper Tesla? Well, production of the lower-cost model has started, but the ramp will be slower than expected as the company focuses on maximizing deliveries before the EV tax credit expires. So we will have to wait a bit longer for that. So what's the verdict on Tesla's Q2? The bull case is clearer than ever. Tesla isn't just a car company, it is an AI and robotics company. The launch of robotaxi is a massive milestone. If they can scale that, and if the Optimus robot is even a fraction of what Musk predicts, the potential is astronomical. He confidently stated that if they execute well, Tesla has a shot at being the most valuable company in the world by far. Now, with that said, the bear case is also very real. Margins are being squeezed by tariffs. The key EV tax credit is disappearing, and the company is burning through cash to fund its ambitious projects. There could be, in Elon Musk's own words, a few rough quarters ahead. It's a classic battle between near-term challenges and a world-changing long-term vision. So what do you think? Is the robotaxi and Optimus future worth the squeeze? Let me know your thoughts in the comments below. Now, before we finish up here, let's go take a quick look at the stock over on Yahoo Finance. So we're taking a look at Tesla Inc., stock ticker TSLA. Right now, the stock is hanging right around $318. So this is actually over the last 5 days. As you can see, we have a loss of negative 3.40%. Right here where this blue bubble is, that was when earnings was, and we saw a big drop after that. Now, over the last day, actually we have seen a little bit of an increase. If we pop over to here, it's not too bad. The stock is actually up just over 4% as of right now. So clearly this is showing that there are at least a substantial number of people that felt like that dip was a reasonable buying opportunity. So, at least some people are absolutely still bullish on the stock. If we take a look down here, we've got an EPS trailing 12 month of 1.68. And if we look up here, we got the market cap at just over $1 trillion. Now, if we look at this PE ratio, this is big. This is 189 times earnings. That is a very, very high PE ratio. Now, Tesla has had a very, very high PE ratio for quite some time now. But compared to the consumer discretionary sector as a whole, that is very high. If we actually come up to here, let's take a look at XLY, which is the consumer discretionary ETF. And if we look at the average PE ratio here, we've got 28 times. So yeah, pretty big discrepancy. Clearly, the really high PE ratios, indicate that people are, have high expectations for growth. So there's no way to know what's going to happen in the future. We shall see. So let's actually move over to our stock comparison tool here. Right now, we're looking at the 5-year return of Tesla. And we have XLY, so again, that consumer discretionary ETF, and VOO, which is the S&P 500 ETF, reflecting the market as a whole for the most part, at least in the United States. So over the last 5 years, at the bottom here, we have XLY at 71%, VOO at 111%, and Tesla leading the pack at 202%. Not too bad. If we look here over the last year, things are getting a little bit closer. Tesla saw this big spike up, but then we saw this big dip here. This was actually leading up to the election, and then right about here was when the election happened. And as you can see, there was a big spike. But since then, the stock has definitely struggled, coming down to basically its pre-election numbers. But since then, we have seen it come back up. And then obviously this dip right here at the end with that earnings report. So if we pull this in just a little bit further here, this is over the last 6 months. We can actually see here this big dip in Tesla stock has led to it trailing the pack in terms of these three securities. We have Tesla at negative 24%. XLY, the consumer discretionary ETF, at around negative 2%, negative 2.68. And we actually have VOO in the green. We have positive 5%, not too bad over the last 6 months. We pull it in even further, as we can see here, the story stays similar, although XLY has been profitable over the last month. Nice, plus 3.9%. Tesla down with that, after earnings. Now they're down to around 12.44% if you held Tesla over the last month. And VOO here in the purple, standing pretty strong here at positive 5.73%, so not too bad. So what do you guys think? Do you think the Tesla here is going to be able to rebound from this and continue its growth, or do you think that it's going to be rough sailing for the foreseeable future? Whatever you think, let me know down in the comments.